What's going on, everybody? Chris here from projectoption.com, and in today's trade recap, I'm going to walk you through an IWM Iron Condor that we traded, and I'm going to walk you through the adjustments we made to turn this trade into a no-risk trade. Now, this trade did end up profitable, but unfortunately it did not hit our profit target, but nonetheless, I think it serves as a good example of how you can adjust an Iron Condor position. Now, in today's trade recap, we'll discuss our recent IWM Iron Condor position that we adjusted into virtually a risk-free trade without substantially reducing the profit potential. So let's go ahead and look at the opening trade details. In this trade, we traded IWM, which is the Russell 2000 ETF. Now, we entered this trade on March 28th, 2017, and we went into the April 2017 expiration cycle, and we sold the 129, 134, 135, 140 Iron Condor for $2.93. Now that means we sold the 134, 129 put spread, and we sold the 135, 140 call spread. Now this trade is pretty tight and is almost considered an iron butterfly because those short calls and short puts almost share the same strike price. But it is technically an Iron Condor since the short strikes are different. Now we went into this trade with a 66% profit target, which means we wanted to buy back the entire position for a net debit of around $1. And with a $5 wide call spread and $5 wide put spread and an entry credit of $2.93, we had an initial loss limit of $2.07. We sold this particular Iron Condor 5 times, and since we collected $2.93 or $293 in premium per Iron Condor, we collected a net premium of $1,465, which is our maximum profit potential. Now our maximum loss potential in this case is $207 per Iron Condor multiplied by 5 contracts, which comes out to $1,035. Now, when we first entered the position, IWM was trading just above $134, and a few days later, IWM had risen to $137.50. With that move, we decided to roll up a portion of our long 129 puts to reduce the downside risk. Now, before we made that adjustment, we had $1,035 of risk to the downside, which means if IWM was below 129 at expiration, we stood to lose just over $1,000. Now, the exact adjustment that we made was to purchase 4 of the 132, 129 put spreads for 23 cents each spread. Now, that adjustment reduced our downside risk by over 100%, and after that adjustment, we actually had profit potential on the downside. So that trade cost us a total premium of $92 to put on, since we paid $23 in premium per spread, and we did that 4 times. Now that means we reduced our profit potential by 6%, but at the same time we reduced our downside risk by over 100%. Now a few days after that adjustment, on April 10th, IWM was trading back down to $135, and we had the opportunity to roll our 140 calls down 1 strike to the 139 calls. Now to do that, we purchased 5 call spreads. The exact call spreads that we purchased were the 139, 140 call spreads for 14 cents each. Now, before making that adjustment, our upside risk was $1,127, and after we made that trade, our upside risk was just below $700. Now, to put that trade on, we shelled out $70 in premium, which reduced our profit potential by 5%, but at the same time, we reduced our upside risk by just below 40%. Now, a couple days later, IWM was down to $134, and we had another opportunity to roll down the 139 calls to the 137 calls. Now, we only rolled 4 out of the 5 calls because that's all we needed to do to eliminate our upside risk. Now, before we put this adjustment on, we had $700 of upside risk, which means that if IWM was above $139 at expiration, we would lose about $700. Now, after we made this call spread adjustment, we actually reduced our upside risk by over 100%, and we actually had $11 of profit potential on the upside. Now, since we paid 23 cents to buy the 137, 139 call spreads, and we did that 4 times. That cost us a total of $92 in premium, which reduced our profit potential at the time by 7%. So we paid 7% in profit potential to reduce our upside risk by over 100%. That to us is a good trade. Now let's compare our risk profile before and after these adjustments. So before the adjustments, we had $1,035 of upside risk and downside risk since we had a $5 wide call spread and a $5 wide put spread, and we collected a net premium of $2.93, and we did the whole thing 5 times. Now we had $1,465 of profit potential. Now after the adjustments, we had $11 of profit potential on the upside and $89 of loss potential on the downside, but we still had $1,211 of profit potential if IWM was in between our short strikes at expiration. This means that after those adjustments that we made, we reduced our upside risk by just over 100%, we reduced our downside risk by just over 90%, but we only gave up 18% of our initial profit potential. Let's take a look at our ending profit and loss after we close the entire position at expiration. Now let's go ahead and look at all of the premium collected and premium paid for this position. So we collected $1,465 initially, and then we also collected $160 in premium on April 21st when we sold our long 137 calls for 40 cents a piece. Now we paid out a total of $1,444 in premium for the spread adjustments and also buying back our short 135 calls for $2.33 a piece on the day of expiration. Now since we collected $1,625 in premium and we ended up paying out $1,444 in premium, our net P&L at the end of this trade was $181. Now this trade was not super successful, but at the end of the day, we were able to remove our upside and downside risk while only reducing our total profit potential by 18%. Now to visualize how this trade actually played out, let's look at a trade timeline of the entry, the adjustments, and then expiration. Now we can see that we entered the trade when IWM was in between 134 and 135, and our assumption was that IWM would continue to trade between the 130 and 140 range. Now, when IWM rallied after those first few days, we rolled our long 129 puts upwards. Now, a couple days after that, IWM had fallen back down, and since some time had passed since we entered the trade, all of the options in IWM had lost some value, and we were able to roll down the 140 calls to the 139 calls for a very cheap debit. Now, a few days after that, IWM had fallen even further, and we had the opportunity to roll the 139 calls down to the 137 calls, and on April 21st, we had to close the entire position. Now, what are the pros and cons of this type of management style for an iron butterfly or iron condor position? Well, the pros are that you take advantage of market cyclicality and you reduce or eliminate the risk of one side and potentially both sides if you get enough cyclicality and you're able to roll those long options closer to your short options. Another pro is that you allow for more profit potential than just closing the trade entirely. Now, in regards to the downsides of this type of management style, you do pay a lot in commissions, especially if you make 3 or 4 adjustments. In this case, we probably would have been better off if we adjusted the put side one time and then waited a little bit longer and adjusted the call side one time. Instead, we adjusted the put side one time and then we also adjusted the call side twice, which obviously is very commission intensive. Of course, we didn't know what IWM was going to do at the time, so we had to take what plays were on the table at that current moment. Now, another con is that the position can get harder to track, especially if you're only rolling a portion of your options closer to the stock price. Now, lastly, with this type of approach, you aren't locking in profits, which means you could end up with a losing or a break-even trade when at the time you could have closed the trade for a profit. Thank you so much for watching this trade recap, everybody. I hope you enjoyed it and learned something. If you did, please take a moment to subscribe to our YouTube channel so that you can get all of our future video content as we come out with it. Now, if you want to check out some more videos, please click on the video link on the right-hand side.